There are only two ways to make money on an investment: capital gains and cash flow. Understanding the difference will change how you build your portfolio. First of all, let's define them. So, starting with capital gains, it's when you buy something, you wait for it to appreciate in value, and you sell it for more than you paid. You make money at the exit. However, most students and people think this is the only way investing works. Buy low, sell high, but this approach requires timing, creates tax events, and depends entirely on the market cooperating. So now let's move on to cash flow, the second way you can make money on an investment. It's owning something that generates income while you hold it. So that could be dividends from stocks, interest from bonds, or for example, rent from a property you own. You make money during the holding period. So the advantage of cash flow is that it doesn't require you to sell anything. You just hold. You get paid for holding, and you can reinvest that income to buy more income producing assets. So that's how the compounding machine works actually. So what does this mean for students investing? Well, it means that when building your portfolio, it's best to combine both capital gains and cash flow. So, for example, you can have growth stocks for capital appreciation, basically for capital gains. And you can have dividend stocks, which are also known as value stocks, or for example, bond funds for cash flow. So you can generate that cash flow while holding it. Real estate assets as well, like property, offer both capital gains once you sell the property, as well as cash flow if you're renting it out. For someone like myself at 20 years old, you should tilt toward growth because you have time and you can take on the risk relatively. But don't ignore cash flow entirely. Reinvested dividends are one of the most powerful compounding mechanisms. So, for the student reality check, I have both in my portfolio. My index funds are primarily growth for capital gains, and my bond allocation provides some cash flow, which when I receive the coupons, I can reinvest again into my portfolio, helping with that compounding effect. So over time, as my capital grows, the cash flow piece will become more important. But right now, the priority is accumulation through growth and regular contributions. If you're smart, ambitious, and still unsure what to prioritize, this is for you. I'm opening a waitlist for behind the scenes Blueprint Lab where I share the exact systems I used to juggle internships, studies, building, investing, fitness, and social life in my 20s. Tools that start from where you are, not where you should be. Join using the link in the description.